Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company that's hit a bit of a snag. Let's just say their stock might be feeling a little deflated. We are looking at ESS Tech's latest report, and it looks like they've received a warning from the New York Stock Exchange. The problem, they're not meeting the NYSE's minimum market capitalization standard. Basically, the value of all their stock hasn't been high enough for a sustained period. Think of it like this. Imagine a store whose products aren't selling well, so the overall value of the store goes down. Specifically, their average market value over the last month was less than $50 million. Not only that, but their stockholders' equity, that's the value of their assets after all debts are paid, was also below $. It's after all debts are paid, was also below $50 million last September. Now ESS Tech has some time to fix this. They had a few months to come up with a plan to get back in good standing with the NYSE. This is called the cure period. If the NYSE accepts their plan, they'll be checking in every 3 months to make sure ESS Tech is following through. If the plan isn't accepted, or if they don't improve enough during the cure period, the NYSE could start the process of removing their stock from the exchange, meaning it'll be harder to buy and sell their shares. For now, their stock is still listed and trading on the NYSE, so you can still buy and sell their stock, while the company tries to come up with a solution, but the company is in a bit of a trouble. The company said that this warning doesn't affect their day-to-day operations or their reporting requirements to the government. They're looking at all their options to get back into compliance with the NYSE. The company also reminded everyone that the future is uncertain. They cautioned that things might not go as planned and that their ability to fix this problem depends on many things. This part is usually referred to as a forward-looking statement because it refers to the future plans of the company and the risk of things not going according to plan. They mentioned that the ability to regain compliance depends on the plan that they're going to create, if the NYSE accepts it, and their own ability to execute the plan. There's also the risk of their stock being suspended from trading and other risks that they've mentioned in their previous reports. It's the company reminding people that, hey, we will try our best, but there are risks involved in the future. Finally, they announced they put out a press release on March 28, 2025 to let everyone know they received the warning from the NYSE. Companies do this type of announcement as required by rules. You can also find the press release as an attachment in the report itself. It's just extra confirmation of what they've already said in this report. And now let's talk about the big picture here. ESS Tech is facing a real challenge. The fact that their market value and equity are both below the NYSE's minimums is a serious concern. They need to act quickly and decisively to regain compliance. Their strength lies in their ongoing business operations. The company says that the issue with the NYSE doesn't affect their daily activities. A big risk is that they might fail to get their stock price high enough in the near future and get delisted from the NYSE, which is one of the major US stock exchanges. That would make it harder for investors to buy and sell their stock, and that may impact the company's operations even if they said it doesn't. In conclusion, ESS Tech has some work to do. They need to convince the NYSE they have a solid plan to improve their financial situation. Investors should keep a close eye on how this situation develops over the next few months. Thanks for watching. If you found this breakdown helpful, please give us a like, leave a comment, and subscribe for more corporate decoder content. It really helps the channel out.